Have you ever heard the term financial information? I'm sure that most of us have. The term financial information in the accounting industry refers to information found on the financial statements of a company that tells how good or bad a company is performing. Now that you know what it means, do you have any idea why financial information is important? Financial information, as seen on the financial statements, gives users of this information, which is usually creditors, investors, and potential creditors and investors, the tools they need to make informed decisions about their interactions with the company. The financial statements provide all of a company's financial information. They're the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. Together, these reports tell the story of how well a company is operating and how much of a risk investing in that company would be. Now, sometimes there are problems that occur when creating the reports that provide the financial information. Some of the most common problems that occur in the reporting process are reporting errors. Reporting errors are errors that are a result of such things as miscalculations or transposing numbers. For example, let's say that Henry is the bookkeeper for Wasabi International. While calculating the net income for the company, Henry added $5,000 that really should have been subtracted from the company's income. This miscalculation means that the net income for the quarter is overstated by the $5,000. Another problem that may occur when deciding what to include on the financial reports involves disagreements in judgment. Now, this term should be pretty self-explanatory. In simple terms, it means that what I believe and what you believe may not be the same. I bet you're wondering how this can possibly have anything to do with financial information. Well, let's look back at Henry and another situation he's run into when preparing the financial statements. Wasabi International recently had to replace a machine that's used on the production line. The terms for the purchase of the machine are for the company to pay half of the cost up front and the balance when the machine is completely installed. Henry decides that he needs to report the portion of the expense in this accounting period that was actually paid out. His supervisor, Mark, wants to wait and report the expense in another accounting period. Either option is acceptable. However, there will be a difference in the net income reported on the income statement as well as the information on the statement of cash flows. If Henry reports the expense now, the net income will be less and the cash outflow will be a whole lot more. But if he waits to report the expenses until the next accounting period when the machine installation is complete, then the current period will show a better net income and less cash outflow. Most of the time, disagreements in judgment are related to the timing that the expenses are reported. The third problem that we're going to discuss is fraudulent financial reporting. Fraudulent financial reporting means to deliberately omit or misstate financial information with the intent of deceiving investors and creditors. This is the one action that is anything but an honest mistake. Fraudulent reporting practices are such things as changing the amount paid to a vendor, changing the amount of income that's received by a company, failure to report expenses, and that's just to name a few. These types of activities usually occur because of the desire to pad the financial statements or make them look better. Let's go back to Henry again. What would happen if Henry decided that he didn't want to report the expense of purchasing the new machine at all? He knows that if he does report it, then the company's going to have a lower net income in this accounting period compared to the prior accounting period, and that's not what creditors and investors want to see. However, not reporting the expense is definitely a fraudulent reporting practice. Financial information refers to information found on the financial statements of a company that tells how good or bad a company is performing. There are 4 reports called the financial statements that provide all of the company's financial information. They're the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. 3 typical problems that occur when creating the financial statements are reporting errors, disagreements in judgment, and fraudulent financial reporting. Reporting errors are errors that are a result of such things as miscalculations or transposing numbers. Disagreements in judgment simply means that what I believe and what you believe may not be the same. Fraudulent financial reporting means to deliberately omit or misstate financial information with the intent of deceiving investors and creditors. Each of these problems have a major impact on the financial statements, which in turn has an effect on the financial information that is used by potential and current creditors and investors that a company may have.